Let's start with the stimulus. We're on the cusp of getting more stimulus. Looks like the House is certainly going to approve it. Then we're going to have the Senate, $1.9 trillion. Whether you like it or not, certainly business leaders like it. We got a letter out this week from a lot of business leaders saying this is a great idea. The polls indicate the masses like it. If business leaders and masses like it, can they be wrong?
Business leaders have been wrong a lot in history, and they're right that stimulus is a good idea. Many of the business leaders who signed that letter have also been saying that the level of the stimulus is risky, and so we need stimulus, but not all of this stimulus. I think that it's better to have stimulus than not to have stimulus, but I think there's enormous risk we are running that with all that we're doing, there's not going to be enough room for the public investments that are vitally important, and perhaps even more importantly, or as importantly, we're going to set ourselves up for inflation concerns, and then we're either going to have inflation or we're going to have a collision between fiscal and monetary policy to contain inflation of a kind that doesn't usually end well. It's not hard to see the internal contradictions. An economy with 3% GDP gap, getting 9% GDP fiscal stimulus is one way to see it. An economy with a net private savings rate that's 7-8%, dealing with an 18% of GDP budget deficit is another way to see it. Yes, there's fundamental public investments we need to make. Yes, there's a need for relief from COVID. And God knows we need to do things about inequality. But I think the scale of what we are doing, a nearly $2 trillion savings overhang, a 14% of GDP, $2.8 trillion of fiscal stimulus, the Fed with its foot on the accelerator to the floor and saying that it's going to stay that way for a very long time and be pulled up without warning. I don't think it's amazing that we've seen more turbulence in financial markets. Some of that's got to do with the micromechanics of those financial markets, but some of it's got to do with the broader environment.
Well, let's go to that point just exactly, because after that dramatic spike up in the 10-year, some people said it was more technical than something more fundamental. We heard from Jay Powell, the chairman of the Fed this week, saying, don't worry about this. We're fine. Insofar as the yield goes up, it's really because it's a vote in the confidence in the future of the economy. Is that right? Is that what we're seeing, is a vote of confidence in the future economy?
We saw a lot of things. We saw tech stocks go way down. That doesn't seem like a vote of confidence in the future of the economy. We saw commodity prices go way up. That doesn't seem like a vote of confidence in the future of the economy. We saw credit spreads widen. That doesn't seem like a vote of confidence in the future of the economy. So I don't think that this all has to do with confidence. It's certainly true that with cyclical expansion, you could expect to see some normalization of interest rates, but we've seen a move that's as large in the last month as in any month in years. Same thing in the last quarter. I don't think anybody should be slave to the markets. I don't think anyone should be certain of any kind of inflation forecast. But I think on risk analysis grounds, we certainly shouldn't be dismissive of the risks of inflation at this point. We certainly shouldn't be dismissive of the risks of an overheat in the economy at this point. And I'm concerned that we're having a dynamic that is in many ways reminiscent of the 1960s, when conflicting demands, great social concern led well-intentioned officials, terribly dedicated, serious, and thoughtful officials, to be too optimistic about what the economy could handle and let things get away from them. And inflation went from 2% in 1966 to 6% in 1969 before there were any supply shocks. And it seems to me that we're at risk of making that kind of mistake again.
Well, Larry, if we are on something of a sugar high right now, how are we ever going to come down off of it? Let me put it a different way. If Jay Powell is reassuring us so we don't have a temper tantrum, are we going to have a temper tantrum sooner or later, no matter what?
You know, anytime you say anything is sure to happen no matter what, I think you're on very shaky ground, David. So I'm not going to say that. I think there is a tension between Chairman Powell, and look, he's got an enormously difficult job, and we're lucky that he is there. But I think there is a tension between Chairman Powell's statements that there's no way rates will be raised without large amounts of warning, on the one hand, and on the other hand, that it's a long way off. And on the other hand, we're concerned and will do what's necessary to maintain price stability. Because while it's certainly not time to be raising rates or even cutting off QE right now, I think there's a real possibility that within the year, we're going to be dealing with the most serious incipient inflation problem that we have faced in the last 40 years. Now, that sounds very dramatic. And in part, the reason I say it is because we haven't really faced very serious inflation problems in the last 40 years. But I do think that we need very much to have a sense of two-sided risk. And right now, I think the risks of inflation, of financial bubbles, of economic overheating, of excessive euphoria in markets, I think those risks are much greater than the risks of deflation, of insufficient aggregate demand. That could change, but right now, I think we are still fighting the last war in the rhetoric of policymakers. We're still fighting the war against a COVID-caused shortage of demand, when the greater threat is a war against COVID, classic wartime inflation pressure. And that's, I think, the disconnect between reality and a certain amount of the policy thinking that's underway.
Okay, so Larry, we always finish with a lightning round. Summer says this time we may have room only for one of them. But let me ask you specifically. President Biden this week said he's really going to take a hard look at our supply chain system. Are we going to have substantial differences in our supply chains a year from now?
I think we'll be more secure in some key areas. I hope that's what we'll focus on. And this isn't going to become an excuse for a lot of protectionism. That's a real risk in my view.
Okay, let me sneak one more in. Janet Yellen says that we are going to be taking a look at corporate tax rates as well as capital gains 2 years from now. Will they be different?
I guess yes. They certainly corporate tax rates should go up. The business community was confident that it would think it was fantastic if rates were 25%, and they'd be happy if they were 27 or 28%, and Donald Trump reduced them to 21. That's a very poor use of resources. Certainly in terms of capital gains, the loophole for estates, so-called the absence of constructive realization at death, we should get rid of that.